Blockchain cannot handle the transaction volume of all capital markets transactions. If you include all high frequency trading and dark pools, you are so far beyond the capacity of blockchain.
That is Dan Doney, Managing Director at DTCC Digital Assets. He believes the biggest mistake people make about tokenization is assuming blockchain is automatically ready for institutional scale, when the real challenge is throughput, resilience, and market structure.
Blockchain networks do not have deep liquidity. And while people may consider $1 trillion in transactions to be deep liquidity on a yearly basis, it's not, folks. That's less than a day's worth of activity.
His perspective comes from working with institutions that move real dollars at massive scale. From repo markets to insurance to treasuries, Digital Asset is already putting key financial instruments on chain. Today, he breaks down what institutions think tokenization is, what it actually requires, and why problems like liquidity, scale, and MEV decide whether this future works. By the end of this conversation, you will learn what has to be true for tokenization to remake financial market infrastructure over the next 3 to 5 years, and what most of the market is still getting wrong. I'm Alex Nwaka, and this is High Stakes. Maybe, Dan, before we get too far into sort of the throes of tokenization, maybe just a really quick 2-minute, 30,000 foot for folks who didn't have the chance to consume the first episode and don't know DTCC, maybe just a quick overview of the organization and roughly the role it plays within the global financial markets, and then we'll jump into tokenization.
So DTCC, the Depository Trust and Clearing Corporation, was formed a little over 50 years ago as an entity owned by the financial market infrastructure players. So we are a component, effectively a DAO, if you consider that we're an entity that's owned and operated by our constituents, the consumers of the financial market that we offer. It is a central securities depository. It is the record keeper for all publicly traded assets. And so your shares of Microsoft and NVIDIA, we're the ultimate record keeper of those shares, among many other asset types as well. We record keep more than $100 trillion worth of assets and service $4 quadrillion worth of transactions, more or less, on a yearly basis. There's really no other institution that's close to that level of servicing broadly. What's interesting about our position in the market is we're a neutral party. By design, by regulatory mandate, and by ownership structure, we are neutral. So it's not like JP Morgan is having to rely on Goldman Sachs for their infrastructure and vice versa. We're mandated to and in a position to really help bring things together so that they can scale to 100 trillion in assets and 4 quadrillion in transactions.
I like to say there's very few organizations that deal on that sort of scale. And so to your point, it's a very unifying, element of what you all do and where you play in the global financial markets. So Dan, maybe going into the topic at hand, I think let's get definitional here. When you think of what tokenization is, what it means, how would you define that for the audience, some of which will not be what I would call digital asset native in any way, shape, or form?
Specifically, it's the use of a distributed ledger to track the ownership of an asset. So in its most precise definition, tokens can actually represent a bunch of things. So here we're speaking of it that way. We're using distributed ledgers to keep track of ownership of assets. We care a lot about what people call real world assets. Again, that's the shares of your Microsoft, NVIDIA, your ETFs and other assets as well. We use blockchain distributed ledgers in addition to traditional database systems to track that ownership. This allows parties who are holding tokens. So let's say you've got in your blockchain wallet shares of Microsoft. You can transact freely with those, with other parties on their wallets. You can move your shares of Microsoft from one to another very efficiently and seamlessly on blockchain rails. So as we launch our tokenization service, this will allow parties to actually convert their traditional holdings, the Microsoft that you might have in your Schwab account, to shares of Microsoft in your wallet so that you can engage in the many kinds of interesting transactions that are now available on blockchain ledgers. Things like various DeFi protocols, DeFi, decentralized finance. It's obvious to your audience, but for folks who are in the institutional space, I want to also make sure that I define these terms.
Super helpful. And you started touching on this as part of your answer, Dan. When you think about the core value prop to DTCC of tokenization, what are those core value propositions, and how do those also then relate to the global markets as a whole?
Probably the most transformational aspect of tokenization and the use of blockchain here is the programmability of assets. The fact that we can actually build the behaviors of an asset, the life cycle of an asset, into the asset itself. So typically, a share of Microsoft would be a record in a database somewhere. And all of the other things about what it does and how it pays dividends and how its governance structure works and beyond would be in other systems. And in fact, each bank's going to have their own system, and sometimes many different systems within that bank that all have to work together around that common object. And when Bank 1 refers to it by its share symbol, MSFT, and Bank 2 refers to it by its QSIP, and Bank 3 in Europe refers to it by its ISIN, we all have to figure out if they're talking about the same thing, et cetera, et cetera. In this new world, that is a smart contract, a unique address on a distributed ledger. In its logic, its behavior is programmed in to the asset, its life cycle. The way we do corporate actions and dividend payments can actually be programmed into the asset. And now, instead of having a whole bunch of other systems that have to agree around the disposition of the asset is actually defining its life cycle. So the way we would like to say that is, instead of the asset being in the system is in the asset. That solves major interoperability challenges in the financial system, and the back office and middle office cost of having to address and reconcile any differences in those components are massive. The blockchain affords a very different baseline that we can work from in order to get shared infrastructure and shared understanding. But make no mistake, it's a very complex ecosystem. And the way that somebody sees something in Europe may be different than in the US, and et cetera. And so the way they define things. And so all of that needs to be possible to frame on blockchain. And we've done a lot to make that quite possible. But once you do, it has a revolutionary impact. But that's one big advantage. The other big advantage is different asset types all can sit on the same rails. So the cash components and the securities components and commodities and crypto and alternative assets and private assets and debt instruments can all sit in the same rails and interact with each other directly. This allows for what's known as atomic settlement. And so I can actually move that value all as part of one transaction that settles instantly. That's a big additional new feature that you don't get. That's very difficult within the legacy system. So we work with major institutional banks. They'll have 14 different accounting systems in the bank for each different asset type. This one for alternatives, that one for equities, this one for debt, et cetera. And they all have to be reconciled. And if you want to do a transaction that involves corporate debt and in a commodity, you're talking about major system integration and challenges. Blockchain, super easy. Develop a smart contract that wires these things together. That unlocks massive innovation opportunity. And so we're excited as we're moving into the first step is you've got to get it into token form. And so with the tokenization service, we're doing that. But there's another subtle element of that. Blockchain networks do not have deep liquidity. And while people may consider $1 trillion in transactions to be deep liquidity on a yearly basis, it's not, folks. That's less than a day's worth of activity, like a fraction of a day's worth of activity in the institutional world. There's the level of depth and the size of transactions in the institutional world are much bigger than blockchain networks currently have. So putting something in token form where it's going to exist in token form is not affording the same depth that you see in traditional markets. But when you can convert freely back and forth between the two forms, and initially it'll be a 15-minute conversion with our tokenization service conversion order. Eventually, it'll be fast and even immediate in terms of the conversion between them. Now, market makers, if there's ever a difference in price or a very large order that occurs in the blockchain space, can actually move assets, fulfill that order, fulfill the market imbalance. And that provides a unified market, one in which liquidity, you have a global liquidity pool of traditional and blockchain rails. And frankly, blockchain hasn't had that, especially for high quality assets. So we're excited about that.
And Dan, maybe, not to get too simplistic, but I think, in some ways, the core business and the core value prop of DTCC is really in the sort of clearing and settlement, right, that you guys provide globally. There are going to be plenty of folks that don't really understand at the sort of like step-by-step level, like all the different things that are involved in making that happen today. And we're describing sort of a new world where that collapses massively in terms of the complexity, the number of parties. I don't know if you can do it in sort of a, maybe even a minute or two, because it's a pretty complex process, but maybe just giving a stark, here is how it is today, and here's what it's going to look like in 2 to 3 years. Maybe an impossible provocation to do in a minute or two, but I wanted to see if you're up to the task.
All right. Well, let me see what I can do. So I am a institutional finance. I'm not a native. I'm a sojourner as I step into that field, and so my language will be from the outside in as I talk about clearing and settlement. And so I'm sure people will be chuckling from the inside of the experts who actually live this stuff on a daily basis for 40 years will probably chuckle at the way I described that, but maybe it's better. All right. So when you execute a transaction, so let's say you're using your Schwab account and I buy 2 shares of Microsoft, and someone else, let's say maybe using your Fidelity account, you've separately placed an order to sell 2 shares of Microsoft, and they match and they come together, and 2 shares of Microsoft are to change hands. It feels to you like it happened right away. Now remember, there is one holistic record of all shares of Microsoft that needs to be accounted for, and it can never double count. It can't be wrong, so that whenever dividend gets paid, exactly the right person is getting paid and not 2 times, et cetera, et cetera. So there's one whole record that all of this reconciles down to. That's what DTCC's ledger is on this. And so each of those parties, Fidelity and Schwab, have an account with DTCC. And as that trade takes place, it's actually got to move off of Fidelity's books and on to Schwab's books as part of that. Well, what that means is it's happening at DTCC. So in affecting that trade, I placed an order, you placed an order, they matched, that's the trade. And now that must settle. What settlement means is the point at which all aspects of the transaction are complete. Those banks actually have to exchange some cash as part of this. And so that's a different rail, et cetera, et cetera. All of that comes together in a transaction that is T+1. So 1 day later, all of the obligations associated with the trade that occurred get settled. So that's great. Now, it's not like every time someone trades 2 shares and for across all of that there's going to be an individual movement for each one of those. They get aggregated or netted so that it's maybe while you sold the 2 shares and then someone else from Fidelity bought 2 shares, those net out. And so they don't actually have to move. So all of these get aggregated to a single movement that happens all the next day. Now, what would happen if Fidelity went out of business between the time when that trade was made till when it was executed? No shade on Fidelity. They're a fine financial institution. Wouldn't happen. So what happens there? DTCC's job is to ensure that there are no failures. It must always execute. That action is, there are subsidiaries of DTCC, NSCC, which clears trades of securities, and FICC for fixed income, which clears fixed income trades. These are our regulated subsidiaries of DTCC who are responsible to make sure that all trades clear. What do? Each one of those brokers collateralize their positions, and in the event that we ensure that all the obligations are going to be met. This isn't important for 2 shares of micro. I mean, it is, because actually these things aggregate to very large levels. But we serve in that function of clearing the trades. A cleared trade is one where each party can now forget is working solely with that clearing entity, and they don't have to worry about the solvency of the counterparty in the trade. And so this is how our markets have scaled to the tens of trillions of dollars a day of transactions that happen every day. That sounds like a lot. What's all this about? Well, again, remember the mandate. People have a right to not have to worry about whether or not they're going to get what they did, what they traded the next day. You want to make sure that assets are secure. It matters. So we offer those services. There's an interesting point here. And that role that DTCC provides in providing the consensus, the ultimate ownership position for assets. There's a new technology that provides consensus in a way at global scale. It's called blockchain. So how does this play? How does that fit into this organization, given that there's a technology which is really designed to do this? And people say, that's it. We don't need DTCC anymore. Well, that's would be true if DTCC stood back and said, we don't want to use blockchain, or it's not important, or we're better than that. It's either an existential threat or an opportunity. We can retool to leverage these core capabilities in the broad financial ecosystem and to bring them. By the way, blockchain is not at a tier 1 level. Tier 1 is the highest level of availability and assurance of financial systems for systemically important features. Blockchain isn't at that standard for a bunch of reasons that we can get to, but it can be. And it can be, especially when it's tied into a broader set of processes. That's our job. That's what we're doing. We're bringing this level of assurance to this new world. And it actually clearing is actually a very important function in general. And even though many blockchain transactions are atomic simply means that the trade and the settlement happen together. There isn't, as there is in traditional markets today, for the purpose of scale, a separation between the trade and the settlement. So if all transactions happen atomically, do we need clearing services? Actually, the answer is no, you don't need clearing services. But anytime there's a loan, a future obligation, I'll give you an example. I just bought a house. Okay, so at the point where I agreed to buy the house, said, yes, put it under contract. That is the trade. A number of days later, we went to a title insurance agent and we ensured all the documents were lined up. All the value had to be pre-positioned properly. All terms were understood and the trade settled. And guess what? The title was transferred as part of that. It's exactly equivalent to what happens in the securities space. You could have had a clearing agent in between who, at the time when we signed that contract, basically guaranteed both parties, it's done. I will ensure that both parties can make this happen. Doesn't typically happen, doesn't happen in small individual transactions, but it is a valuable service to be able to execute a trade and then know it's done. Trust me, the party who was on the seller's side, who was going to buy another house, would have loved that guarantee that it was going to go down and I wouldn't walk before the end of that date. Anyway, these core services can scale out to the level of a market. Blockchain is a very powerful tool in helping it scale to the market. But here's another little trick. Blockchain cannot handle the transaction volume of all capital markets transactions. If you include all high frequency trading and dark pools, you are so far beyond the capacity of blockchain. Well, so now what? How are we going to do that? Well, there may be many blockchains. In fact, there's already many blockchains. Now you have the problem of what's the total disposition of this asset across all of these blockchains? And by the way, it's not just the sum of all of the positions so I had Microsoft shares on this one. Is it the right Microsoft shares, first of all? But the sum on that one and the sum on this one, if shares are moving between those blockchain ledgers via bridges, now you have to account for, not double count, et cetera, et cetera. So you still need those same, even in a fully blockchain enabled world, you still need the overarching view that is, by the way, more than a blockchain. in order to get the whole disposition of a security. That's actually what DTCC is focused on. We have built out a tool called LedgerScan, which is really the ledger of ledgers, which allows parties to use whatever blockchain ledgers they want. And by the way, whatever traditional accounting and ledger systems they want to get a holistic ownership as value moves in real time across all of those blockchain ledgers. So again, it's DTCC actually sees blockchain not as a threat, but an opportunity to lead. We are a neutral party. We can actually affect positive change in a comprehensive way. It's our mandate. And so we're leveraging that position, not to stifle innovation, but quite the opposite, to actually tackle some of these core issues so that parties can connect in and do their own thing. And so that challengers can have much lower barrier of entry to come into this very comprehensive infrastructure and innovate even more rapidly.
So as a neutral party, Dan, you mentioned earlier that, you're really watching, really two different core constituencies that are bifurcated. One is sort of the revolutionaries or sort of the disruptors. And then there's really the folks that are, the incumbents, so to speak, to use a term. How do you see and define those two constituencies today? And you mentioned, hey, there's some battle lines that are being drawn around certain key issues. Maybe for the audience, give your sense of how you see it today and how that may evolve between those two constituencies over the next, let's call it 12 to 18 months.
Well, the one thing I won't do is name names and even necessarily focus on the specific battle line issues. But I'll say this, so many exciting, new, innovative models, lending models that allow me to take, for example, securities lending and using DeFi lending protocols, actually take and do securities lending very efficiently. Collateralization models where I can use cryptocurrencies or like a whole range of asset types as collateral against lending trades or a whole series of other operations. There are many exciting capabilities that you see in the DeFi space. What folks in that world seldom fully appreciate is the complexity of the institutional world and this whole set of requirements that follow global scale, international economy, and all of the individual regulations and requirements in each one of those. And so there's a lot that actually has to go into it. There's a lot of very specific functions. I'll give you an example. We've done a lot in the collateral, using DeFi protocols or DeFi frameworks to do collateral management. And collateral is pretty cool in something like a whole range of really cool DeFi protocols that allow for lending. But collateral swaps, so a huge part of the institutional world is when you collateralize a trade, you need to optimize the things you used as collateral. You may need to replace one for another on a long run trade and making sure you enforce all of the necessary rules to allow real-time swapping of that value against collateral. DeFi protocols really aren't even close to the kind of sophistication that's required. It takes a lot. We built a lot on blockchain to make these things possible. Okay, so challengers. It's a little bit more complex than you think it is. And regulations really do matter. You have to be overseen. Individuals must be accountable for decisions for any engineering change such that you did this and it caused that. We must know who the you was so that people are accountable. All of the regulations are about that, making sure that informed people who understand their responsibilities are accountable when they make a mistake. So DeFi, it's going to be that way if you want to service this big market. Now, the problem is for institutions is if you can only do one piece of your business this way, then you have to still go back and reconcile and do the rest of your business the way you did it before. And what that means is blockchain is yet another system that they need to integrate into an already complex back and middle office. It's only when this can affect most of what they do that it becomes so compelling and frankly so cost effective for them to do. And by DTCC wading in and bringing our massive inventory and diverse inventory, the ability for banks to actually do most of their things now on blockchain rails, it will change. And that's where we think this is going to be a real tipping point for institutional adoption. So how do we bring both sides together? Ultimately, it's to create and to ensure the ecosystem remains open, that standards become important. So, as you mentioned, every challenger who's out there imagines and says, wow, why do we need DTCC? We can be DTCC. Let's say somebody out there who's doing a really good job on tokenization and says, see, we can do it all. We don't need DTCC. Okay. So if you're working, if you become wildly successful and suddenly everybody tokenizes everything through you, guess what? You will be governed as DTCC. You'll be systemically important. There's important rules on the way that you behave that we're subject to in part of this. You will grow to be what we are. And what's more, probably because there's going to be many of you with that same claim, somebody's going to come along and say, well, but I'm tired of having to work with 40 different DTCCs. I sure would like there to be one institution, one responsible party who could actually just unify all of you guys. Well, that's what caused DTCC to exist in the first place. So what we do and why we do it, we're in a good position to actually help lead. And frankly, if we don't do it well, we should be replaced. We understand that. Believe me, we understand that at a leadership level. And that's why we're moving so briskly and aggressively into the space. But we're not new either. As you know, DTCC acquired Securrency, the company I founded, and into this, Securrency had been at it for a decade, doing some of the most advanced things in compliance and global scale securities transactions, et cetera, in the marketplace. A lot of that expertise has been now deeply encoded into the expertise on how you run $100 trillion systems as part of this 2 years worth of merging the two capabilities together. And we think it's going to result in a much better product.
And it's a good segue into, one of the things I wanted to have you give a sense of for the audience on is some of the work you guys are doing at really the bleeding edge with Launchpad. Obviously, Validation Cloud is thrilled to be one of the participants in the Launchpad, specifically. And I know that, again, it's a very high bar to get into that program. But maybe for the audience, back to DTCC and the public eye is not often seen as an innovator on a lot of things. And to your point, there's much that's been done in the background there. So maybe just a little bit on that the Launchpad initiative. And really what it's meant to sort of solidify for DTCC as it relates to digital assets specifically.
Launchpad, we know that the financial markets, by definition, are a confederation of many parties at global scale. There isn't going to be one universal provider of all financial services. That would actually be really creepy, frankly. So there's going to be many. So this is and always will be an ecosystem. To build an ecosystem, you need a place where everyone can freely come and work together to collaborate in the process of building out an infrastructure. And so there are many blockchain networks. There are an extraordinary number of great technology providers like Validation Cloud who are working in the blockchain space. There are many financial institutions, each with their own individual capabilities and preferences and choices that exist in an ecosystem, and we need this ecosystem to thrive and to evolve. So we established Launchpad for this reason. It's a relatively open environment. It's one which you must be qualified in order to enter into the Launchpad in order to be a part of this ecosystem development. Once you are able to be in the space, you're able to bring your wares to the table, mix it up, mix and mash up with other capabilities in the space to prove out financial services. Why are we doing this? Is it a lark? Nope. This is to test to production, experiment to production. So the idea here, all of the tools which we are using in production are in that same environment so that parties can build on top of that tool set. And so that we know when the experiment and the use cases prove to be successful, the path to production is then very short. So that's what Launchpad is about. Here we're looking, this space is evolving very quickly. And so we're looking at the most advanced technologies and the way that we get to scale solutions, privacy solutions, AI-based solutions and beyond. How does all of this come together? And this is where validation cloud's playing a role. Your Maverick tool is a fantastic tool to allow parties to understand really in natural language using AI methodologies to say, hey, what's going on in this distributed ledger? What threats might be evolving? How is my asset being used in various markets, and which chains are most active? What smart contract protocol? Natural language. You may or may not fully understand blockchain language, and you want to find out what's going on with your value. You've got a nifty tool to do this. We want to throw it in the mix. Does it work like you say it does? What implications does this have for what we're doing? This is how we're able to rapidly integrate the real horizon of technology innovation that's occurring, pull it in so that we can get to a much more robust blockchain-enabled financial market infrastructure.
Thank you for that, Dan. And I would also say one of the most important things that you highlighted earlier around sort of design decisions that are being made as it relates to tokenization and where blockchain is like, there are maybe some gaps today to get to tier one, as you mentioned, and so forth. Do you want to talk a little bit about, let's call it, considerations when you go into tokenization and thinking about different asset classes or the way the tokenization needs to work, and what those design decisions are to be able to get to a place where, in the next 5 years, we can safely say, hey, there's the capability to tokenize really every asset that's out there that exists in the financial markets?
The first important component, we have what we call a compliance-aware token framework. It's not a specific protocol. It's a general set of control practices that you need to safely run securities on any infrastructure, but especially with blockchain rails. So the two, if I were to break it down, there's two fundamental requirements that you need of securities that a blockchain must exhibit for it to really qualify to hold securities. We would call the principles of good control. The first of those is distribution control. It must be possible to know, we don't have to know, but it must be possible to trace all the way from the issuer to the ultimate beneficial owner, exactly who the by name owner is. And by law, there's very specific requirements. You have to be able to communicate with that owner so that they can exercise their vote in a shareholder vote perspective. Also for KYC, AML reasons, so that you can know that it's not a sanctioned entity who is holding those shares. Or in some cases, parties can even understand how their competitors may be manipulating their share structures, whatever. There's a bunch of reasons that you need to be able to connect this. The end result of that is that tokens, let's say tokenized shares of Microsoft, as they move about, the wallets that they sit in must have been registered by a licensed entity. That is a party who understands their necessary responsibilities and who had a proper KYC AML process. It doesn't mean that wallet can't be self-custodied. You can still use your Ledger Nano to hold those shares as long as your financial institution knows you, proves that you actually have control over that device. And with that, your wallet address can be effectively whitelisted and can now hold these tokenized shares of Microsoft. So that's the first component that we insist on is distribution control. The second component that we insist on is recoverability. So many people, maybe blockchain purists, don't appreciate the responsibility that we have to make sure that all value is ultimately recoverable. So they hear stories, and they're right, of someone who lost their Bitcoin wallet, and they search for a decade through trash heaps to try and find it because it's forever lost, whatever, $10 or $100 million worth of value. I don't blame them for going through a trash heap. You can't have a bearer instrument economy, one in which bad actors can damage things irrevocably. So we build into our smart contract framework or any smart contract framework that we interact with a recoverability framework, which allows, in the event of a disaster, lost, stolen, or misappropriated value, the control location, to actually restore that value. Now, blockchain purists would hate the concept. They would say, that's an intermediary, and now my value is no longer censorship free. True. But not having recoverability also wrecks an economy, so, especially with the kind of value that we're talking about. So this piece is a necessary element to a healthy economy. Now, what's nice is the tokens feel and look the same as any other token that you have in your wallet, transacts the same as any other token you have in your wallet. So you get all of the innovation that you expect from blockchain networks. But we have these extra couple features that we insist on that allow us to actually leverage blockchain and all of its innovation to exercise our responsibilities.
When you think about what the next 2 to 3 years looks like in terms of tokenization, in terms of how much advancement and adoption we'll see, I always frame this as tokenization's happening a lot faster than people think. And, when folks say to me, well, we haven't seen a huge amount of equities or a huge amount of fixed income move into tokenized form, I then remind folks that, everybody can't stop talking about stablecoins. And I remind people that stablecoins are really just tokenized US dollars. And that seems to surprise people that we're, moving faster than we think, even though it's, not necessarily explained that way. So do you see specific asset classes that are going to move faster or slower in the next, let's call it 2 to 3 years? And do you think that we could wake up in 3 to 4 years and say, hey, we've got $100 trillion worth of different asset types, equities, fixed income, US dollars, that is all sort of tokenized and on chain and moving value? Maybe just give us your sense of how you see it and which assets will move faster than others.
Yeah. So first, I love your observation there that a stablecoin is, and it actually is, it is a tokenized instrument that actually has a cash backing element that sits in traditional infrastructure. It is a digital twin of the cash that's in accounts. And that's great. That's awesome. It's unlocked a tremendous amount of utility. What we're introducing is the equivalent for securities. Honestly, as fast as the market is interested in the uptake of these assets, we can go to our no action letter. Has a good chunk of our inventory is eligible to actually go into this conversion process. We don't expect it to happen overnight, that boom, 100 trillion but it's not the technical or framing challenge. Is really what is customer demand for these assets. A missing piece for blockchain in general has been stable, easy to price assets that are not speculative in nature, that have a strong investment thesis at scale. So look, there's lots of, my gosh, you guys are responsible for yield instruments that are producing real yield. So I'm not trying to discount that. There is always a little bit of buyer beware in that model, but having the high quality, easy to price, I know it's my shares of Microsoft or NVIDIA. And there I know what the price is. I can see, because there's deep activity, that I'm getting a good price for my asset. That's been missing. And as a result, when people are going one place to speculate and another place for real investment, you're always going to be, sort of driving more and more of that activity. This will be the first time there's a crossover where real market making, real institutional activity can park together in the same place that speculative activity is taking place, and can actually move freely between various environments. That helps bring it all together. So we're excited about high quality, easy to price, highly liquid assets on blockchain rails. And people say, well, they're already easy to trade in my Schwab account. Why does that make a difference? True, they are. The kinds of things you can do to use them as collateral and to other layered transactions on blockchain rails that you can't really do in your traditional accounts, that starts to really matter. So now, to answer your question, what assets do I expect to see? We do think that these publicly traded equities and the ability to begin to move more at international scale to make it very much easier for parties overseas to get access to U.S. equities, that's going to be a big unlock in these models. ETFs and effectively money market ETFs in general, that is going to be a really hot model. So the reason ETFs, as opposed to mutual funds, as our friends at Wisdom Tree, John O. Steinberg's so great at talking about this topic, ETFs are a better wrapper around an investment thesis than mutual funds that has tax advantages and other things. Tokens are a better wrapper than ETFs as a model for unlocking innovation on an investment strategy. So we think there's going to be a proliferation of these things, especially because blockchain can almost entirely automate the asset management component of it, the underlying trading activities, the rebalancing activities, et cetera. We're working on automating those components through smart contracts, which means the barrier to entry for creating ETFs. You have all the tools you need to bring that thing to a much broader scale through an automated ETF wrapper. So we think that's going to affect things. And honestly, that substantially reduces the costs of the large asset managers today who are experts in investment strategies. And so that's a big asset class. Everyone always pointed to tokens are going to really open up the private markets. Well, not really, right? Have we seen that yet? No, but they will. Trust me, it will come too, but it's actually a lot harder than people thought. It's not just taking the shares and allowing them to fractionalize and put things on chain, because if they're hard to price and it's hard for people to get the necessary information to understand what they're investing in, yeah, it can be a token, but I sure as heck don't want to buy it from you if I'm the last to know that your tokenized piece of real estate burned down. If there's not, proper information disclosures, et cetera, that goes along with it, and we think that's possible on blockchain as well, then you're not going to get liquidity there. And so we're working on some of those aspects.
I think the summary of that as well, just to give a temporal component of it, Dan, do you agree that it's, much of this from the public view is happening in the background much faster than people think? Is that a good description? Because I do find that, there is this skepticism of like, it's going to take a lot longer and so on and so forth. And as somebody that's really on the front lines of one of the biggest organizations in the world that's going to help, sort of facilitate this much tokenization, I'm just want to hear you sort of put maybe a temporal, spin on like, there's a lot happening and it's happening really fast. And most of the people out there don't really quite get how fast.
Yeah, well, I'll say they're right. This is a long journey. But this journey has been going on for more than 10 years. I founded my company more than 10 years ago. Okay, so and with the purpose of doing exactly what we're doing today, there were many hurdles that needed to be tackled. We are launching this year. Okay, so this year, access to this broad inventory is going to be possible, and with the institutional safeguards that people are expecting as part of this. And it was not a fast track. You have to do a lot to make that possible, a lot more than I even fully appreciated that we had to do to make that possible. But we're at the very end of that process. So the 90% of the iceberg that's below the water is mostly built out, right? So now the last little bit. But the last little bit, the speed, once you have these high quality things in token form, of innovation around services will happen so fast in this world. And some of the really cool things that we've seen already, those things can happen almost overnight. So stay tuned.
Fantastic. Dan, maybe last thing I'll twist your arm on, based on all the discussions you have in the institutional realm and otherwise around tokenization, what do you think is the biggest misconception, or frankly, the most like damaging sort of maybe misused, like factoid or otherwise, that sort of damages either the public's like understanding or their sense of like what tokenization can do?
Well, okay. First of all, there's been a ton of nonsense for a decade or more in the token world. I mean, look, in 2015, 2016, 2017, 2018, it was basically people who were taking assets that they couldn't sell any other way, putting their shares in token form and running around and selling them to people. So there was a ton of nonsense. That's largely way behind us in general. The next big thing is people not fully appreciating the security responsibility and the resilience responsibilities that an institution should have, which then puts investors at risk. So there's obviously been a number of high exposure failures or even thefts that have occurred in the blockchain space. And so that has mom and pop who are just, looking to make sure their nest egg is not gone. I'm one of those guys, a mom and pop. And, I want to make sure it's not stolen. And I wake up tomorrow and, oh my gosh, my retirement is gone. Blockchain wants those people. In order to get those people, all of these other components that need to get built and are being built, but are a part of a highly resilient, highly available, highly secure infrastructure. This really is needed to get over the line and to make this ubiquitous. A couple other little things, making sure the mom and pop aren't really worried about the safekeeping of their keys unless they really want to. And, some things that are still clunky from the user experience in the blockchain world. If you want to be that guy or girl, then have at it. But also for the 90% of the rest of the people, making it super seamless. Blockchain could do a lot better that way, and it's mostly there.
So I know we're up on time here, Dan, but maybe a plug for maybe a future long form. You and I talked privately about some of the challenges that are out there today that blockchain still hasn't figured out how to solve.
DTCC is actually leaning in on these difficult tech topics with a whole coalition of tech providers to help develop the most sophisticated market solutions. We could go into each of those and probably have a long form episode on each one of those topics. I look forward to the next discussion on this topic. But there are a lot of still wicked problems that exist for blockchain. We want to solve them so that the entire market economy runs on blockchain rails. Why? It's much more efficient. It's much more accessible. It's much more exciting in terms of a new way of doing business. And so let's get there.
From your lips to God's ears, as they say, Dan. Let's park it there. Dan Doney, Managing Director and CTO of DTCC Digital Assets, and our first repeat guest on High Stakes. Thank you for joining us, Dan. And we will see you again on another episode, I am sure. And so always appreciate the time.
Thanks, Alex.
That's a wrap on High Stakes, the podcast where Web3 meets the real world. For more insight into how blockchain and AI are reshaping institutions, head to validationcloud.io and follow @validationcloud across all socials. Stay tuned for more conversations from the front lines of innovation. I'm Alex Nwaka. See you next time.